Hey guys. All content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Today was an ugly day in the market. In a bit of some shocking news, the SEC is telling American audit firms to be cautious about taking on new Chinese firms to trade in New York. This warning follows several businesses switching to U.S. auditors amid an ongoing dispute between regulators in Washington and Beijing over access to audit work papers that could lead to about 200 companies being kicked off American stock exchanges. As the Bloomberg article specified, China and Hong Kong are the lone two jurisdictions worldwide that don't allow American inspections of documents, with officials citing national security and confidentiality concerns. SEC Acting Chief Paul Munter said in a statement that auditors need to fully vet their clients before engaging them, including making sure they are able to get all the information they need both from a foreign company's management team as well as their prior reviewers. Such arrangements, Munter said, pose special challenges that raise questions about whether the newly engaged registered public accounting firms will be able to satisfy their responsibilities to serve as the lead auditor. What quickly jumps to me from this article is that in recent weeks, we have had two Chinese stocks randomly jumped in valuation for no reason. I wonder if this move by the SEC has anything to do with these recent events. Funny enough, today a clip was posted on Superstock of an interview with Ken Griffin where he is low-key bragging about how controlled the media and prices are. Take a quick look and also, see if you can keep count of how many times Griffin blinks in this short 1-minute interview.
The work that everyone has done over the last 30 years to commoditize news, data, and information means that our markets today are much more efficient in the short run.
Is there less alpha to be had?
Well, because the markets are more efficient, there's less alpha to be had. So think about a company announcing earnings. Today, those earnings will be analyzed. People will have preemptively decided, if a company is going to announce this, here's what we're going to do. So that literally within seconds of the earnings announcement, you're already seeing the stock price move and adjust to where it should be to reflect all the news that we have. Now take an interquarter period where you're looking at that data that comes from consumer credit cards, for example, giving you insights into how the quarter is evolving. All these dynamics are making the markets more efficient, more fair, but for the industry, for all active managers, it's reducing the amount of alpha that's available to us as a community.
Dude gives me serious weird vibes and just makes me want to buy more meme stonks. Now, a pretty big article came out today talking about energy trading being stressed by margin calls up to $1.5 trillion. We have been talking over and over about the energy crisis that is taking place right now, which is pushing inflation out of control. Particularly in Europe, where officials are working to intervene to prevent energy markets from completely stalling while governments are stepping in to backstop struggling utilities. Finland has already begun warning of a Lehman Brothers moment as power companies are now facing sudden cash shortages. Equinor's senior vice president for gas and power said in an interview that liquidity support is going to be needed. The issue is focused on derivatives trading while the physical market is functioning with the energy company's estimate for $1.5 trillion to prop up paper trading as a conservative estimate. Now, let's stop for a moment and think about what Equinor's vice president said. At some point in time, $1.5 trillion just somehow became a conservative figure, a low-ball assessment of the total cost of the straining that margin calls are putting pressure. To say this is a huge red alarm of bad things to come is perhaps the greatest understatement of 2021. A lot of people aren't realizing that this is unsustainable. But this isn't even the worst part yet. The Equinor senior vice president went on to say that utilities have been forced to secure multi-billion euro credit lines, and that this capital is already dead and tied up in margin calls. If these companies needed to put up that much money, it means that liquidity in the markets dried up. The problem with this is that Europe doesn't really have much leverage or room for flexibility in this part. Gas is a global commodity and they don't have that much supply, so there is really not much they can do. The liquidity crisis has largely been spared by the biggest trading houses for now, but this is just a matter of time until they make a mistake or miscalculation. The recapitalization of the industry and the rebalancing of portfolios are questions being addressed in quarterly fashion instead of years, which is how they usually operate. There is a dread panic and the sense of longevity is long gone. I made a small joke about Europe being forced to resort to wood for heating, but upon some internet searching, this alternative isn't even satisfiable. Germany, for example, is struggling to maneuver this way because suppliers are out and in the drying process of the current wood supply. They are resorting to countries like Poland to import wood, but as the energy situation worsens, Poland will no longer be able to satisfy the demand, and the problem will just keep on getting worse and worse until everything implodes. I cannot believe that all meme traders are focused on the daily stock price action of GME and AMC, crying on Twitter and Reddit while blatantly ignoring the bigger picture here. Europe's energy crisis is going to cause its markets and economy to implode and collapse. If this isn't solved soon, we could see the worldwide economy get a reset, and with hostilities between Russia and Ukraine not easing at all, this problem will just keep on worsening over time. Grab your tendies and hold them dear to chest, because something could definitely happen relatively soon, and by that I mean either this year or next year. Again, I am not going to pump dreams down your throat and give you dates I myself don't even know. There are too many variables in worldwide economies being affected by shortages and conflicts that it's impossible to time anything out, so just hold and relax. I want to contrast this bearish thesis and news with that of Wall Street analysts, who seem to have transitioned from objective probability forecasting into dream pipe and hope coping propaganda. Jim Caron, chief fixed income strategist at Morgan Stanley, believes that the United States of Wall Street still has a good chance to have a soft landing, though he says that it's a very hard bet to place as the markets are not necessarily calling for that. Rick Rieder, the chief investment officer of global fixed income at BlackRock, said that in the wake of the jobs data, he doesn't think a soft landing is that hard to land the place on as the economy is in pretty good shape. I don't know who this Rick Rieder think he's fooling. Maybe BlackRock, being the world's biggest asset manager with little to lose and all to gain from an economic collapse, has them giving inverted forecasting to set incorrect market expectations to line their own pockets, but what he said here most certainly does not match their actions. I have said many times that BlackRock isn't buying the dips yet, which is paramount because everyone else is telling each other to do so. But this corporation along with others are holding still, sitting in cash for something, and it's giving me serious anticipation that the bottom is going to be much lower than people think it is. This analyst Rick Rieder is assessing the economy in good shape, yet BlackRock is acting opposite as to how they would if the economy was so. Furthermore, as we just discussed, even analysts in Europe are complaining about the extremely low amount of liquidity happening in the markets, which means an extreme lack of volume and buyers, with these institutions being over-leveraged and taking loans non-stop to uphold the stock prices as high as they can. Funny enough, Rick Rieder even said that BlackRock is sitting on a fair amount of cash at the moment, which to me was like the biggest middle finger to the audience he just fooled in this same interview earlier on. Goldman Sachs's chief economist Jan Jatsius said a soft landing is also still possible for the US economy and puts the likelihood for a mild recession to start in the next year at about 1 chance in 3, or 33%. We always talk about rate hike and the Fed and Jerome Powell, but what about Canada? Well, the Bank of Canada is set to deliver a 4th consecutive outsized interest rate hike as well. Yeah, and it was completely missing from headline news all day today. All economists surveyed said they expect Governor Tiff Macklem to raise benchmark overnight rate by at least 50 basis points, with a significant probability that it is also raised to 75 basis points. That would bring the policy rate to 3.25%, which would be the highest among major advanced economies. You know, one of the things that Wall Street loves to tout is that even though the energy crisis is happening mainly in Europe, the problem is mostly isolated over there, and that America should be fine long-term aside from small hiccups because we aren't dependent on Russian energy export. This is obviously them lying to you, but what is key to note here is that they completely ignore Canada, another economy separated by an ocean and not dependent on Russia for energy, also experiencing high inflation that is dragging their economies through the floor. The 75 basis points is also being favored by the 6 biggest major commercial lenders in Canada, which include Goldman Sachs, JP Morgan, UBS and Moody among them. Goes to show just how terrible the state of affairs is and how blatantly they lie to you every time on TV when they tell you the economy is due to bounce back. It's been an awful day for the entire world in general today. Stocks went down, and especially GameStop, Ape and AMC, but if you take away anything from this video, it's that you guys cannot hyper-focus on price action on the daily. Unless you are actively buying in chunks and need to try to anticipate a huge dip, don't even look at it that much. Instead, try to find interest in the events happening globally because right now they are the ones that are going to dictate daily price action as well as potentially offset MOIS. I look forward to discussing further developments taking place in China this week, so stay tuned for that. Guys, I know I sound like I brag, But if you are losing money holding stocks or trading them and are looking for a big and diversified trading community, I highly suggest you give my Discord a chance. Join it and tag me in a message and let me know you are interested in day trading access, because I will let you have full access if you want to check things out a bit. We have hundreds of people using our buy and sell alerts, and today we were green throughout all of our trades, and I will be more than happy to be fully transparent with you and show you so you can see for yourself and trace back months worth of content to see if it's right for you. If you aren't day trading, we also offer active AMC and GameStop chat rooms full of investors talking and discussing the things happening. The link is in the video description. I only ask for a chance to see things for yourself at no cost to you, just click the link. I am always available and answering any questions you guys have and talking about the economy and trade ideas I might have. Hope to see you guys there this evening. Sorry for releasing the video a bit late today. With all that said, thank you for making it to the end. I hope to see you guys on the next one. Enjoy the rest of your day and to the moon.